Two traders open the exact same chart, the same market, the same moving average, the same number configured on the line, everything identical down to the last detail. And yet, one of them silently builds a fortune with that line, while the other slowly bleeds out with it, trade after trade, never understanding why. Same chart, same line, same configuration. So what does the first trader know that the second one doesn't? That question is the entire reason this video exists, and the answer is going to surprise you because it has almost nothing to do with the number you choose. Let me make you a promise. By the end of these few minutes, I am going to hand you the exact moving average configurations I would place on every time frame you actually trade. The daily, the 4-hour, the 1-hour, and the 30-minute. Precise numbers, no guessing, no spinning the wheel in panic after every loss. But before I give you a single one of those numbers, you have to understand what separated those two traders, because if you don't understand it, you are going to do exactly what almost everyone does. You are going to write down the numbers, you are going to configure them perfectly, and you are still going to keep losing. If you saw my previous video, the one about the moving average secret that 99% of traders get wrong, then you already heard the first half of the answer. The moving average is a filter, not a trigger. If you haven't seen it, finish this one and watch it afterward, because the two together form one complete lesson. But there is a second half that I never told you, and it is precisely the reason why one trader prospers with the same line that destroys another. It is this. The configuration of the line by itself means almost nothing. What matters is whether that configuration matches how long you actually intend to hold the trade open. Think about it this way. A man who buys to hold a position for 3 months and then makes his decisions based on a line built with the last 9 candles of a 30-minute chart is reading the mood of a single afternoon to make a 3-month decision. Of course, the line shakes him from side to side. He paired a short memory with a long intention, and the market punished that contradiction without mercy. That was not the number, that was what was silently killing the second trader, and it is almost certainly what has been killing you. I knew a trader, I'll call him Alejandro, who was one of the smartest people I have ever seen in front of a chart. He read everything, analyzed everything, knew every indicator by heart, and still lost. When we finally reviewed his trades together, we discovered something that left him frozen. Alejandro bought stocks with the intention of holding them for weeks, but he adjusted his exits by looking at a very fast-moving average on minute charts. Every small mid-afternoon fluctuation scared him and pushed him out of positions that, looking at the daily chart, were going perfectly in his direction. He did not have a knowledge problem. He had a matching problem. He had paired the wrong tool with his true intention. So the real skill was never finding the best configuration. It was matching the configuration with your time frame and with how long you actually plan to stay in the trade. If you get that right, the line becomes silent and useful. If you get it wrong, it is going to tear you apart no matter how perfect your number is. That is exactly what this video is. I am going to walk with you through the 4 time frames that most of you operate. The daily, the 4-hour, the 1-hour, and the 30-minute. And I am going to give you the exact configurations for each one. But I am also going to give you the one simple rule that sits beneath all of them. The rule that tells you which line belongs to which chart, exactly what job it is doing there. Because the numbers are easy to forget. The rule, once it is yours, you keep it for life. So stay with me through the why. The why is what makes the number stick. Everything I am going to teach you rests on a single idea, and it is the same idea I spent my whole life learning the hard way. The market moves along a line of least resistance. At every moment, there exists a dominant current in the direction the market wants to go, because the weight of money is behind it. Your entire job as a trader is to find that current and stop fighting against it. The moving average is simply the cleanest way ever invented to see that current. It takes the noise of individual candles, the fear in this one, the greed in that one, and averages them into one calm line that shows you where the water is truly flowing. That is all it is. A line that shows you the current. And the only question that matters is this. Over what period of time do you want to measure that current? A line that measures the last 200 days shows you the deep tide of the ocean. A line that measures the last 9 candles of a 30-minute chart shows you the choppy waves of the surface. Neither one is wrong, but you had better know which one you are looking at, and you had better know which one matches the trade you are trying to make. I learned this lesson with my own money, and the tuition was brutal. In my worst years, I was not beaten by the fact that the market was impossible to know. I was beaten by my own impatience. I was beaten by reading a long-term position through a short-term emotion, letting the surface wave scare me and push me out of a trade that the tide was carrying in my favor. The discipline of matching my tools with my intentions came late, and it came expensive. All right, now we can start building. First, I am going to give you the one rule that decides whether you use an EMA or an SMA, because that choice changes everything and almost nobody explains it correctly. Then we will climb through the timeframes one by one. For each one, I will give you the exact configurations I would place on the chart and show you the job that each line is doing. And at the end, you are going to see what surprised me most when I finally understood it. The configurations change as you move between timeframes, but the roles never change. The same 3 jobs are done on every chart. Once you see that, you are going to stop memorizing numbers and you are going to start reading any time frame in the world. Let us begin where every serious trader should begin, on the daily chart, the home of the trend. But before I put a single configuration on the daily chart, I have to resolve an argument, because if I don't, you are going to spend the rest of your life as a trader confused by it. It is the argument between the simple moving average and the exponential moving average, the SMA and the EMA. You have seen both. You have probably switched between them at random. Let me end the confusion permanently. The simple moving average treats every candle equally. The price from 20 days ago counts exactly the same as the price from yesterday. It is calm, it is smooth, and it is slow to turn. The exponential moving average does the opposite. It gives more weight to the most recent prices, so it reacts faster, it sticks closer to the price, it turns sooner. Now, traders argue about which one is better, and that is the wrong argument, because neither one is better. They are different tools for different jobs, and the choice follows a single rule. The shorter your time frame, the more you want the EMA. The longer your time frame, the more you want the SMA. Why? Because on a fast chart, you need the line to react fast, or you are always late. The responsiveness of the EMA is the whole point. But on a slow chart, on the daily, on anything you are using as a long-term trend filter, you do not want it to twitch nervously with every recent move. You want it calm. You want it to ignore the noise and show you only the deep current. The slowness of the SMA is a virtue there, not a defect. And there is one more reason why the SMA wins on the longer time frames, and it is the most important one of all. The 200-day simple moving average is the most watched line in all of finance. Every institution, every fund, every serious trading desk in the world is watching that exact line. It does not matter if you personally believe it is the best calculation. It matters that the entire market is watching it, which means that price genuinely reacts there. When you choose a long-term line, you do not want the cleverest one. You want the one that everyone else is also watching, because a line that the whole world respects becomes real support and real resistance. Good, now we can configure the daily. The daily chart is the home of the swing trader and the position trader, and it is the time frame closest to how I actually operated. It is where the real trends live, where the tide is clearest, and where the moving average does its most honest work. This is exactly what I would place on it. First, the 200 SMA, the tide. This is your line of least resistance for the entire market. It answers a single question: which side am I allowed to trade? Price above a rising 200 SMA, you hunt longs. Price below a falling 200 SMA, you hunt shorts, or you step aside. You do not buy a stock bleeding below a falling 200 SMA just because it looks cheap. The tide is going out. You wait for the tide. Second, the 50 SMA, the trend. Where the 200 shows you the ocean, the 50 shows you the current seasons. It is the working trend that you actually trade. In a healthy daily uptrend, price pulls back toward the 50, finds support, and continues. The 50 is your dynamic line, the place where strong trends breathe and recharge. When price rides above a rising 50, which in turn is above a rising 200, you are looking at one of the cleanest and strongest configurations the market ever offers. Everything is stacked. Everything agrees. Third, the 20 EMA, the pullback zone. Here and only here on the daily, I turn to the exponential because its job is timing, and timing needs speed. The 20 EMA is where a strong trend pulls back before continuing. It is not a signal by itself. It is a zone, a place to start watching for your real entry that comes from price action. The 20 EMA tells you where to look. It never tells you when to fire. Let me show you how they work together, because that is where it becomes powerful. Imagine a stock. The 200 is rising. You are authorized to look for longs. The 50 is rising below the price. The working trend agrees. The price has just pulled back and touched the 20 EMA, and right there it prints a controlled reversal candle on a level you marked earlier. That is the trade. Not because some line crossed, but because three independent witnesses, the tide, the trend, and the timing zone, all pointed in the same direction at the same moment, and the price confirmed it. And here is what I want you to notice. Not once did I use a crossover as a buy signal. Have you heard people shouting about the golden cross, the 50 crossing above the 200, and the death cross the other way? I am not telling you to ignore them. A golden cross tells you something real, that the trend has changed, that the tide may be turning. But it is context, not a trigger. By the time the 50 has crossed the 200, the move is often already well advanced. Use the cross to understand the climate. Do not use it to time your entry, or you are going to buy the top of the first leg and get shaken out on the pullback. This is the same lesson from my previous video, just dressed in new clothes. The line is a filter, not a trigger. The 200 filters which direction you are allowed to trade. The 50 filters whether the trend is with you. The 20 narrows down where to look. And then a separate skill, reading the price at the level, pulls the trigger. The moving average never pulls the trigger. Burn that into your mind and half of your bad trades disappear. So that is the daily. 200 SMA, 50 SMA, 20 EMA, tide, trend, timing. If you traded nothing but the daily for the rest of your life, you could do a lot worse than those three lines and the patience to wait for all of them to agree. But most of you do not trade only the daily. You go lower. You want to time things with more finesse, catch faster moves. So let us go down one floor to the 4-hour and the 1-hour, and I will show you how the configurations change and, more importantly, how the jobs stay exactly the same. When you go down from the daily to the 4-hour chart, something subtle and important happens. You did not change markets. You did not change the trend. You simply put a magnifying glass over it. Everything I said about matching the tool with the time frame still holds, but now your time frame is shorter, so your lines become faster and the EMA starts earning its place. Let me give you the 4-hour first, because for many of you it is the true sweet spot. Fast enough to catch a move in a few days, slow enough that you are not glued to the screen losing your mind over the noise. On the 4-hour, I want three lines: the 20 EMA, the 50 EMA, and the 200 SMA. Notice what changed and what did not. The 200 is still an SMA. It is still the tide, because even on the 4-hour, that long line is doing the same slow job of watching the world. But the 20 and the 50 have now become exponential, not simple. Why? Because you went down to a faster time frame and the rule holds. Shorter time frame, lean toward the EMA. You need the trend lines to react faster here, because the moves are quicker and the pullbacks are sharper. Their jobs do not change. The 200 SMA tells you which side you are allowed to trade on this chart. The 50 EMA is your working trend. The 20 EMA is your pullback and timing zone. Tide, trend, timing. The same three roles. Faster tools. You are not learning a new system. You are reading the same system at a higher resolution. But the 4-hour gives you something that the daily alone cannot. And this is the most valuable idea in the entire video, so pay close attention. You use the higher time frame for direction and the lower time frame for timing. This is how a real trader uses multiple time frames together, and it is pure line of least resistance thinking. You go to the daily and read the tide. The daily 200 is rising. The daily 50 is rising. The higher trend is bullish. Good, now you have your direction and you do not argue with it. Then you drop down to the 4-hour and you wait patiently for the 4-hour to pull back to its 20 EMA and offer you a clean entry in the direction the daily already gave you. The daily tells you where. The 4-hour tells you when. I knew a trader, I'll call her Valentina, who mastered exactly this method after years of frustration. Before, she would see a nice setup on the 4-hour, take it, and only afterward realize she had been buying against a daily tide that was falling the whole time. The multiple time frame method made that error structurally impossible for her. The higher time frame always filters the lower one. That single change transformed her results more than any new indicator she had ever tried. Now let us go one floor lower to the 1-hour. The 1-hour is the bridge. It is where the swing trader and the day trader meet. the moves are faster again, the noise is louder, and your lines adjust to match it. On the 1 hour, I want the 9 EMA, the 20 EMA, and the 50 EMA. Do you see the pattern? Continuing, everything has shortened. The 200 has largely stepped aside on the 1 hour. You are usually trading within a move, not mapping the entire ocean. The real work is 3 faster lines. The 50 EMA as your 1 hour trend, the 20 EMA as your pullback zone, and a new fast line, the 9 EMA, as pure momentum, the line that sticks closest to the price and tells you how strong the immediate push is. The 9 EMA is a momentum tool, not a trend tool. When price rides tightly along a rising 9, the move has real urgency behind it. When price breaks below it after riding it for a while, the immediate momentum has cooled. It is a wonderful signal on fast charts and terrible on slow charts, which is exactly why you only see me reach for it down here on the 1 hour and below and never up on the daily. Right tool, right floor. And a word of caution as we go faster because it matters more with each floor we descend. The lower you go, the more the moving average lies to you. Not because the math changes, but because the noise grows. On the daily, a touch of the 20 EMA is significant. The market thought about it. On the 1 hour, the price will pierce your lines 20 times in a session for nothing more than the random breathing of the market. The lines are still useful, but they demand more confirmation, not less. This is exactly where you lean on the other tools, on volume to show you whether a move has conviction, on reading price action. On fast charts, the moving average is a member of the jury. It is never the judge. One floor remains, and it is the noisiest, fastest, and most dangerous in the building, the 30-minute, where the day traders live. The 30-minute chart is where most accounts go to die. Not because the time frame is evil, but because it is fast, and speed magnifies every defect you have. Every drop of impatience, every weak hand, every itch to trade when you should be sitting still. The 30-minute chart finds it and charges you for it. On the 30-minute, I want the 9 EMA, the 20 EMA, and the 50 EMA, all exponential. By now you can read this yourself. We are on a fast floor, so everything is EMA. No slow, simple lines down here. We need responsiveness. The 50 EMA is your intraday trend, the backbone of the session. The 20 EMA is your pullback and timing zone, and the 9 EMA is your momentum line. 3 lines, 3 jobs. The same 3 jobs you have seen on every chart in this video. The slowest line you have, the 50, plays the role of the tide for this time frame, because down here the 50 is as far back as the relevant memory of the day trader goes. And the law of multiple time frames governs here more strictly than anywhere else. On the 30-minute, your direction comes from the 1 hour and the 4 hour above. You do not let a 30-minute chart decide where the world is going. It cannot see that far. It can only time your entry in a direction that the higher charts already handed you. A day trader who ignores this, who reads direction only from the 30-minute chart, is reading the surface chop and calling it the tide. He will be shaken out all day and never understand why. Now take a step back with me, because here is what I most want you to take from this video. The configurations changed on every floor. 200, 50, and 20 on the daily. 50, 20, and 9 down on the 30-minute. SMAs up top, EMAs below. If you only collected the numbers, you would think you learned 4 different systems today. You did not. You learned 1. On every time frame, you place 3 lines that do 3 jobs. The slowest line shows you the tide, which direction you are allowed to trade. The middle line shows you the trend, the working current you trade around. The fastest line shows you the timing, the pullback zone where you start hunting your entry. Tide, trend, timing. The numbers that fill those 3 spaces become smaller as you go down in time frame, and the lines become faster as you descend. But the 3 jobs never change, not once, on any chart, in any market in the world. Master that, and you will never open a new chart again and feel lost. You will not need someone to hand you the configurations for the 15-minute, or the weekly, or some market you have never traded. You will look at the chart, you will ask what my holding period is, and you will choose a slow line, a middle line, and a fast line to match it. And you will read the tide, the trend, and the timing like you have done it 1,000 times, because you will understand the why, and the why travels to every chart. The numbers never could. Let me give you the configurations one last time clearly so you can pause and write them down. On the daily, 200 SMA, 50 SMA, 20 EMA. On the 4 hour, 200 SMA, 50 EMA, 20 EMA. On the 1 hour, 50 EMA, 20 EMA, 9 EMA. On the 30-minute, 50 EMA, 20 EMA, 9 EMA. And the rule that binds them all, Higher time frame for direction, lower time frame for timing, always. But I would be lying to you, and I would dishonor everything I learned the hard way if I let you leave thinking the configurations are what matters. They are not. I lost fortunes with perfect information in front of me. The lines were never my problem. My problem was the man reading them. It was the patience. It was the discipline. It was the refusal to wait until all three witnesses agreed. The itch to trade when I should have been sitting on my hands. The inability to take the small loss before it became the big one. The configurations are the easy part. You learn them in 20 minutes today. The hard part is becoming the kind of trader who actually obeys them when real money is on the line and your heart is pounding. Discipline lives in the hands, not in the head. And discipline is built through repetition, through hundreds of trades where you choose to wait instead of act, until waiting stops hurting and becomes part of who you are. The market will still be here tomorrow. The wheel will still be there, tempting you to spin it. Do not do it. You already know the configurations. The only thing left to build is the patience to wait for them.